Okay, so get this. A single building in St. Louis just sold at a 98% loss, and some analysts are sounding the alarm, saying it's the first domino in a silent crash that could bring down the entire banking system. So is this just a bunch of hype, or is there something really going on here? Let's break down their argument.
Right, so you might be wondering, how in the world do we get from one office building to a total nationwide banking crisis? Well, the analysis we're digging into today makes a really bold claim. It says this one building isn't just a building, it's a crystal ball for the whole American financial system.
And this is the building at the heart of it all, the AT&T Tower in St. Louis. According to the source, what happened here is basically the opening scene of a financial drama that could end up affecting every single one of us. Okay, just let these numbers sink in for a second. A little while ago, this tower was valued at over $205 million. Its recent sales price? $3.6 million. Not a typo.
That's a 98% loss. I mean, that's not just a bad deal. The analysis we're breaking down argues it's a terrifying sign that the real value of these massive commercial buildings is being completely reset.
And if you're thinking, well, that's just St. Louis, think again. The source immediately points to New York City. A tower on Broadway, once worth $600 million, just sold for less than $200 million. Their whole point is that this is a pattern, and it's happening everywhere.
So what is going on here? Why are these gigantic, beautiful buildings suddenly worth pennies on the dollar? The analysis claims the trigger is something called the maturity wall.
Okay, brace yourself for this number. By 2026, over $1.5 trillion in commercial real estate debt is all coming due. See, these were loans made back in the good old days of near-zero interest rates. Well, the party is definitely over.
So what is a maturity wall? Think of it like a giant traffic jam, but for debt. A massive pile of loans all need to be refinanced at pretty much the exact same time. And that creates a huge problem.
And here's where the pain really starts. The old loans that are coming due, they had interest rates of, around 3%. The new loans to replace them, we're talking 8, maybe even 9%. That is a massive shock to the system.
But wait, it gets worse. It's not just that their costs are exploding. At the exact same time, their income has completely collapsed, right? The whole work-from-home thing means these buildings are sitting half empty. The source has a name for this, the double helix of destruction.
So let's put ourselves in their shoes. Your mortgage payment is about to triple, but half your tenants have left. You can't pay the new loan. Refinancing just isn't an option. What happens then?
And this is the critical turning point. This is how a real estate problem for a few building owners, they argue, morphs into a full-blown banking crisis for everyone.
Now you'd think it's the big guys on Wall Street holding all this risky debt, right? Nope. According to this analysis, almost 70% of this commercial real estate debt is held by our smaller, regional, and community banks. And these smaller banks, they just can't afford to admit these loans have lost 98% of their value. It would wipe them out. So what are they doing? The source claims they're playing a game called extend and pretend. Basically, just kicking the can down the road and praying that something changes.
And if you need any more proof that things are really bad, the source points out that it's not just small guys struggling. Huge, sophisticated investment firms like Blackstone are literally just walking away from these buildings, mailing the keys back to the bank and taking the loss.
Okay, so office buildings, regional banks, why should you actually care? Well, here's how this problem allegedly starts to ripple out and hit the rest of the economy.
They call it the urban doom loop. It goes like this. Property values crash. That means cities collect way less in property taxes. So they have to cut essential services. Think police, firefighters, sanitation. And when cities get worse, well, more people and businesses leave, and the whole cycle just repeats. And here is the most direct impact on Main Street, a credit crunch. These banks are so terrified about the losses on their books that they're slamming the brakes on lending, and that chokes off the lifeblood for small businesses trying to grow or just get by. All of this, of course, leads to the one question that really matters. Is my money in the bank safe? Well, the source makes a pretty startling claim. They say the FDIC, that's the government insurance for your deposits, only has about 1 cent in cash for every dollar it's supposed to be protecting. And it gets even more concerning. The analysis points to a provision in the Dodd-Frank Act that allows for something called a bail-in. In simple terms, this means if your bank fails, your savings over the insurance limit could legally be converted into bank stock, which would likely be completely worthless.
So, after painting that pretty grim picture, the source doesn't just leave you hanging. It offers a potential game plan for what you can do. And I want to be super clear here. This is their advice we're explaining, not ours.
The entire strategy really boils down to this one idea. They argue that right now isn't the time to be chasing big returns. The game has changed. Now it's all about making sure you simply get your original capital back, safe and sound.
So practically, what does that look like? They suggest a few things. Spread your cash across different banks to stay under the FDIC insurance limits. Look at assets where you're not depending on someone else to pay your back, things like treasury bills. They also mention holding physical assets like gold. And finally, get aggressive about paying down any debt with a variable interest rate.
In the end, the analysis concludes that a massive wealth transfer is basically baked into the cake. It's coming, one way or the other. So it doesn't ask if it's going to happen, it leaves you with one final very pointed question. Are you prepared?